The market at one point was up over 4% today. When I say the market, I mean the NASDAQ. Now look at the NASDAQ, 1.75. It got as bad as 1.92%. And we still have a half hour left in this market. It has been insane. If you guys remember yesterday, we had the market down 5%, up 4.5%. When I say the market, I still mean NASDAQ because I'm looking at the NASDAQ as this is a tech-driven rally and it's going to be a tech-driven fall. So I'm following the NASDAQ all the way. Yes, the S&P is down 1.26%. The Dow is down 0.6. It's no coincidence, though, that the NASDAQ is leading up and leading down. Here's what's interesting to me. Look at this. Guys, Apple's down 4.67% while Nvidia is only down 1%. That's incredible. Look at Google, down 1.5%. Not nearly, it's worse than Nvidia. I can't believe that. That's absolutely incredible. You would have thought that Nvidia, leading the market up this much, would have been the one leading it down. I still think that's going to happen, but it's been beaten up pretty handily lately. It was at $153 a share very, very recently and got as low as $94 a share. And currently, let's see the price of Nvidia right now. Nvidia is currently at $96 a share. Wowzer. 1 year ago, almost 1 year ago exactly, it was at $75 a share on April 19th, 2024. Guys, this market is up and down, and it can feel very, very scary. But as they say, you don't make money in stocks up here, you make it down here. It's been proven time and time again that if you just follow some basic tenets of investing, you will do very, very well. The average person only makes 5 or 6% returns in the market over long periods of time because they buy at the wrong time and they sell at the wrong time. Look at ARK Investment. ARK Investment is still up from its founding days, yet it's been the biggest destroyer of wealth in the last 10 years. Why? Because people bought at the wrong time. Same with Bitcoin. When Bitcoin goes back down to 10, 15, 20,000, it's going to be an overall destroyer of wealth because people buy at the wrong time. This is something you have to remember over and over. This is what we preach about every single day. Don't chase the hype. You need to repeat this to yourself every single day. If you can't do that, then you need to you need to stop opening your brokerage account. You need to stop opening the news. You need to stay away from these things because it'll just drive you insane. It's already hard. When you can get in and out of investments that quickly, that's what makes the decisions bad. And there's a reason why real estate is such a good investment for so many people, because they're forced to stay into it for long periods of time. You can't just go tomorrow and sell your real estate holdings. It takes time to sell. In that time, you calm down. You realize, okay, maybe things aren't as bad as they seem. But in stocks, you go clickety-clack on your computer, and you're out of your stocks. Or your friend made a lot of money on X stock. You go clickety-clack, buy more of that stock. It happens all the time. Now, when we made this channel, we were trying to preach this. And for the first couple of years, market kept going up and up and up. People were saying, you're an idiot, Paul, you're an idiot. I'm an idiot then. And I still bought stocks. I will still continue to buy stocks, not as much as everybody else, because I have a different life situation than everybody. And the stocks I buy are based on a discounted cash flow model. And I make conservative assumptions about the future because I'm okay being patient. You've got to be okay being patient when you buy individual stocks. When it comes to saving for your full retirement, dollar cost average, meet your goals. Assume lower return, save more. It'll work out for you very, very well because as markets fall, you'll be buying stocks at cheaper prices and we don't know when it's going to end. But guys, Apple fell because Trumpy boy sat there and announced his 104% tariff or some crap like that. Now it's down 4.7%. All-time high was 260 the day after Christmas. 260. I didn't realize it was 260. I was going to guess 225. It's now at 172. Let's go see what this company might be worth to us. Because I never expected it to be that low here. Let's do 9% return, 3, 5, and 7% revenue growth, 21, 24, and 27 on profit margin, 24 to 29 free cash flow, and a PE of 20, 23, and 26. Look at this growing return on invested capital. 35% the last 10 years, 48%. For those of you who don't know what that is, it's basically showing a moat. And in a company that's small, that has a lot of growth potential, this shows how much money they can make when they reinvest the money. So hypothetically, if Apple had a lot of areas to grow its business, if it invested $10 billion, $100 billion into its business, it could make $58 billion extra per year for the rest of the time on that $100 billion. They would never stop doing that. Clearly, Apple cannot do that. They're too big. but they're still going to grow over time. We hit the 9% return. Still got a ways to go here. 100 to 114, 210 to 225 on the high side, 146 to 160 in the middle. We got one way to go before it hits what I perceive to be intrinsic value. But guys, am I right on all these? I don't know. The future's unknown. The future's, and we're humans, we make mistakes. That's why you've got to have a margin of safety. That's why you need to have a principle-driven investing approach where you're an investor, not a speculator. You're going to buy as it goes down because the fundamentals continue to get better. You're going to realize that every investment is the present value of all the future cash flows it gets. If you don't understand it, you're not going to buy it. If you can't make reasonable assumptions about the future and feel confident in them, don't even waste your time. Go find something else. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. Look at this for Apple. Year to date, down 31%. It's losing the votes right now. It's not a very popular stock. In the last 10 years, it's up 500%. Overall, it's up 175%. In the long run, it's a weighing machine. The fundamentals get better. The stock does better. Guys, I don't know what's going to happen with tariffs. I don't know what's going to happen with interest rates. We very well could be in a recession right now. There's a lot of indication that we are, but I don't know if we are. All I know is that if you can buy a stock cheap and ignore all the other noise, you're going to probably make a lot of money because news follows the stock price. That's what happens all the time. One of the best examples is Nike at 180. People were telling us we were crazy for being interested. I said, well, let's take a further look under 100. Paul will never hit 100. Let's go see what Nike's at right now. And by the way, numerous stocks like this. Because you know why? Maybe it wouldn't go under 100. All I know is I don't have to buy it. I'm okay saying pitch. Oh, okay, I don't need that one. You have unlimited pitches, as Warren Buffett says. You're at the plate saying, give me every pitch you can imagine, and I'm only going to swing at the ones that make the most sense to me. That's really important to do. Guys, part of understanding investments is what I like to use my 8 pillars. It's the way I look at companies immediately to tell me a story. I look at 8 pillars first. I run Stock Analyzer second. The reason I do that is these 8 pillars tell me some of the questions I need to ask. Why is this selling cheap? Why is it expensive? Why are they buying back shares if it's expensive? Why is the cash flow growing versus the net income dropping, et cetera? All these questions that I can answer. It's so important. It's worked for me from day one as my way of thinking about investments. Doesn't mean it's going to work 100% for you, but you can get a great idea of how to approach companies by understanding these 8 pillars. So if you want to understand them in more detail, click the link below and download our 8-pillar PDF guide. It'll be sent to you immediately. Guys, thank you for your time.